Welcome to Living Your Wealth Today and Tomorrow, the show where we explore how to enjoy the wealth you've already built, as well as how to best plan for a successful financial future. I'm your host, Kelly Ennis, founder and president of Infinity Financial Strategies. Welcome back. I'm Kelly Ennis, your host and guide to making sense of what matters most in your financial life. Today, we're diving into a topic every high-earning professional should understand, especially those of you who've built substantial pre-tax savings in your 401ks, traditional IRAs, or other employer retirement plans. We're talking about Roth conversions, what they are, why they matter, and how they can give you more control over your future tax picture. Because let's face it, if you've done a great job saving, you could find yourself facing some large tax bills later in life, and that's not exactly the retirement reward any of us had in mind. Let's start off with understanding Roth versus non-Roth accounts and what a Roth conversion is. Before we dive into the conversion discussion, first, let me make clear that we're talking about federal income tax in this discussion. State regulations may be different. Now, let's make sure we're on the same page about the two main types of retirement accounts, Roth and non-Roth, or what we usually call traditional or pre-tax accounts. When you contribute to a traditional or non-Roth account, like a standard 401k, 403b, or a traditional IRA, those contributions are usually made with before-tax dollars. That means the money goes into the account before income tax is calculated, which means it isn't taxed when you earn the money. Your retirement account balance then grows tax-deferred, which sounds great, but when you retire and start taking withdrawals, every dollar that comes out is taxed as ordinary income. But with a Roth account, it's the opposite. You contribute after-tax dollars, meaning you pay the tax up front when you earn the money. But once the money's in the Roth, it grows tax-free. And when you take qualified withdrawals later, both your original contributions and all the earnings, those withdrawals come out completely tax-free, subject to a few rules that we'll discuss. So in simple terms, with a traditional account, you get a tax break now, but pay taxes later. With a Roth account, you pay taxes now, but never again, which means you won't be paying taxes on that money's growth. Both types have their place, but for many high-earning professionals who've already accumulated large pre-tax balances, that pay-later strategy can create a future problem, because later often means higher income, larger required distributions, and potentially higher tax rates. And we don't know the magnitude of the future income or the future tax bill. And that's where Roth conversions come in. A Roth conversion simply means taking money you've already saved in a traditional retirement account, like your traditional IRA or 401k or 403b, and moving it into a Roth account. When you do that, you're choosing to pay the tax now, in the year you convert, instead of deferring it to retirement. Once those dollars are in the Roth, they grow tax-free for the rest of your life. No RMDs, no surprise tax hits, and no worrying about what future tax brackets might look like. In short, a Roth conversion lets you decide when you pay taxes and gives you the chance to lock in today's historically low rates while creating the option for future tax-free income. So, why a Roth conversion and not a Roth contribution? Well, because there are income limits, which dictate who can contribute directly to a Roth IRA. In 2025, a person who is married filing jointly can contribute the full amount, $7,000 or $8,000 if you're over 50, if your modified adjusted gross income is less than $236,000. A single filer's income has to be under $150,000. Then there's a phase-out range. And once the modified adjusted gross income for the married couple exceeds $246,000, or the single filer's income exceeds $165,000, they're no longer eligible to contribute directly to a Roth IRA. However, they're not prohibited from converting funds into a Roth IRA. Interestingly, these income limits don't apply to Roth contributions to Roth accounts in employer retirement plans. So how does a Roth conversion work? To do a Roth conversion, you generally, but not always, start with pre-tax funds in a retirement account, money that hasn't yet been taxed. Those are typically the dollars sitting in your traditional IRA or in the pre-tax portion of your employer's retirement plan. Now, let's talk about the Roth side of the equation, because not all Roth accounts are the same. There are two main types of Roth accounts: the Roth IRA and a Roth account inside an employer retirement plan like a Roth 401k or a Roth 403b. They share the same core idea. You pay the tax now so the money can grow tax-free for life, but the rules and logistics differ slightly. A Roth IRA is opened and controlled personally, outside your employer plan. It usually offers broader investment choices and allows completely tax-free withdrawals in retirement once it meets the 5-year rule and the age 59.5 requirement. A Roth 401k or 403b, on the other hand, lives inside your employer's plan. You make after-tax contributions through payroll, and the investment options are limited to what your employer offers. And here's a nice recent change. Starting in 2024, these employer-sponsored Roth accounts, just like Roth IRAs, no longer have required minimum distributions during your lifetime. But here's the key point. You can have both. You might be contributing to a Roth 401k at work while also maintaining a Roth IRA. They're separate accounts with slightly different rules, but both create future sources of tax-free income and flexibility in retirement. For 2025, here are the contribution limits. Up to $70,000 to your 401k or 403b, plus catch-up contributions if age or service-based catch-up provisions apply to you. For IRAs, the limit is $7,000 or $8,000 with a catch-up contribution. Understanding those distinctions and the limits that apply to each type of account sets the foundation for everything we'll talk about next, including backdoor and mega backdoor Roth conversions. So, who can contribute to a traditional IRA? Before we talk about backdoor Roths, quick foundation piece: how traditional IRA rules actually work. Anyone with earned income, wages, salary, commissions, self-employment income, can contribute to a traditional IRA. And if you're married but don't personally have earned income, you can still contribute to your own IRA as long as your spouse has earned income. That's a spousal IRA contribution. Here's the catch. While anyone with earned income can contribute to a traditional IRA, not everyone can take the tax deduction for that contribution. Whether your contribution is pre-tax or deductible, or it's after-tax or non-deductible, depends on your income level and whether you or your spouse is covered by an employer retirement plan. At higher income levels, the ability to make deductible contributions phases out, and for many high-earning executives, it disappears completely. You might still be allowed to contribute to a traditional IRA, but that contribution may not reduce your taxable income this year. It simply becomes a non-deductible contribution, after-tax money going into a traditional IRA. And that's exactly what sets the stage for a backdoor Roth conversion strategy. You may have heard of a backdoor Roth conversion. What exactly does this mean? A backdoor Roth is a two-step process. First, make a non-deductible contribution to a traditional IRA, so after-tax dollars. Remember I said earlier that a Roth conversion is usually done with pre-tax dollars? This is one of the exceptions to that rule. Second, after you've made that contribution, you convert that amount into a Roth IRA soon after. Because you didn't take a deduction for the contribution, in other words, it's already been taxed, you're not taxed on those dollars when you convert. This is the backdoor Roth conversion, and it's a smart way for high earners who are otherwise locked out of direct Roth IRA contributions to still get money into a Roth. Now, there are some caveats here to be aware of if you're pursuing a backdoor Roth strategy. First is something called the pro rata rule. If you also have pre-tax dollars in a traditional IRA, you aren't allowed to cherry pick just the after-tax dollars when you do your Roth conversion. You have to apply the pro rata rule. This rule says that if 1/5 of the money that you have in your traditional IRA accounts is after-tax money, then only 1/5 of the money you convert will be considered after tax, and the other 4/5 of the money you're converting will be considered pre-tax money. That 4/5 will be taxable when you do the conversion. In other words, if you have pre-tax dollars in an IRA, your backdoor Roth conversion will generate a tax bill. The second thing to be aware of is proper tax reporting. The backdoor Roth conversion is a strategy that Congress is aware of and has even mentioned as a way for high earners to get money into their Roth IRAs. However, it is only a successful strategy if it is correctly reported on your tax return. Otherwise, you may end up being double taxed. It's important to keep your tax preparer in the loop, communicate with them effectively, and ensure nothing fell through the cracks on your tax return. Now, let's talk about the mega backdoor Roth. Some employer plans, not all, but some, allow what's called a mega backdoor Roth conversion. Before we get into that, let's review the basic employee deferral limits for 2025. You can contribute up to $23,000 of your own money to a 401k or a 403b, and if you're age 50 or older, you can add a $7,500 catch-up for the 401k for a total personal deferral of $30,500. And there are catch-up provisions for 403b plans as well. That limit includes both pre-tax and Roth employee contributions. So regardless of which bucket you choose, the total combined limit is the same. Now, beyond your own deferrals, the IRS also sets a total contribution limit for 401ks that includes your deferrals, plus your employer's match or profit sharing, plus any non-Roth after-tax contributions. For 2025, that combined total limit is $70,000 or $70,500 if you're eligible for the catch-up. Here's where it gets interesting. If your plan allows it, you can make non-Roth after-tax contributions above your regular wage deferral and then convert those dollars, either inside the plan or by rolling them to a Roth IRA. That's the mega backdoor Roth. It's essentially a way to supersize your Roth savings, allowing you to move tens of thousands of dollars into a Roth each year, far beyond the $7,000 or $8,000 IRA contribution limits. But not every plan allows it. Some don't offer non-Roth after-tax contributions, and even if they do, they may not permit in-plan conversions. Always check your plan's rules before trying it. If you have a large employer plan, talk with your HR or plan administrator to confirm, first, whether your plan has a non-Roth after-tax contribution feature, and second, whether it allows in-plan conversions to a Roth 401k or rollovers to a Roth IRA. For high-income earners, this is one of the most powerful ways to accelerate Roth wealth, but it's also one that absolutely requires understanding your plan's fine print. So, why are we talking about this? Why are Roth conversions so powerful? At its core, a Roth conversion is about control. Control over when you pay taxes, how much you pay, and what your income looks like in retirement. Because in retirement, you're not just managing income, you're managing tax brackets. And the more flexibility you have in where your income comes from, the more options you have to manage those brackets intentionally. So what kind of control are we talking about? Let's start with tax diversification. Having different types of accounts, some taxable, some tax deferred, and some tax-free, gives you flexibility to manage income strategically. If you need extra cash and everything is pre-tax, a withdrawal can bump you into a higher tax bracket. If you have Roth money, you can pull what you need tax-free and stay in control. Let's take a real-life example. Imagine you want to help a grandchild with college tuition. It's a generous and meaningful goal, one many families share. But if all your money is in pre-tax retirement accounts, the only way to fund that gift is by making a taxable withdrawal. And that withdrawal can do more than just raise your income for the year. It can push you into a higher tax bracket, increase your Medicare premiums through IRMA surcharges, or even phase you out of valuable tax credits or deductions. On top of that, because you'll owe income tax on the withdrawal, you'll have to take more than the tuition amount just to cover the tax bill. That means pulling extra from your portfolio at a time when your allocation is likely already more conservative, reducing both your principal and your future growth potential. Now imagine having Roth dollars available as well. You could make that same gift to your grandchild, tax-free, without affecting your income tax bracket, your Medicare costs, or your eligibility for other tax benefits. That's the real-world power of tax diversification. It's not just about spreadsheets or brackets. It's about giving you the freedom to say yes to the moments that matter without worrying about the ripple effects on your taxes or your long-term plan. Then there's the RMD problem. Once you reach age 73, the IRS requires you to take required minimum distributions, or RMDs, from your pre-tax retirement accounts, whether you want or need the money or not. Each year, the amount you must withdraw is based on your account balance and a factor from the IRS life expectancy tables. That factor translates into a percentage of your account that must be distributed and taxed every year. For example, at age 73, the withdrawal factor is roughly 3.8%. If you have a $2 million pre-tax account, your first RMD would be about $76,000. And that entire amount is added to your taxable income for the year. If you're married, your spouse will be subject to RMDs from their accounts as well. Those withdrawals can push you into higher tax brackets, trigger IRMA surcharges, potentially reduce eligibility for credits or deductions. But here's where Roth conversions put you back in control. When you convert pre-tax funds into a Roth, you reduce the size of your future pre-tax balance. And since RMDs are calculated as a percentage of that balance, a smaller pre-tax account means a smaller required distribution later. Meanwhile, the Roth portion of your portfolio keeps growing, with no required distributions at all during your lifetime. So by doing Roth conversions now, you're not just shifting where your money lives, you're reshaping the trajectory of your future taxable income. You're taking control of your income sources, your tax bill, and ultimately, your flexibility in retirement. Let's talk about taking charge while rates are low. We're still in a period of historically low tax rates. And as of today, we know what the rules are, but we don't know what they'll be tomorrow. Strategic Roth conversions right now can lock in low rates before they potentially rise. Since the passage of the Tax Cuts and Jobs Act, or TCJA, in 2017, our current tax brackets have been some of the lowest in the last half-century. And under current law, many of those provisions are set to expire in the next 5 years. A Roth conversion lets you lock in today's known rates and pay tax now on your terms, rather than leaving your future income to be taxed at whatever Congress decides later. When you think about it, Roth conversions are one of the few tax moves that give you long-term certainty in a world where tax law almost never stays still. And if tax rates do rise in the future, the dollars you've already converted and the growth on those dollars will be completely shielded. That's why many high-income households view Roth conversions not as a short-term tactic, but as a multi-year strategy to control their long-term tax destiny. And it's why we at Infinity Financial Strategies evaluate the potential for Roth conversions for all of our households every year. Now, as you evaluate this strategy for yourselves, remember that timing matters. Let's talk about the 5-year rules, because these are what make planning ahead so important with Roth accounts. First, here's something that often surprises people. You can always withdraw your own contributions from a Roth IRA account, tax-free and penalty-free, at any time for any reason. That's because you already paid tax on that money before it went in. Those contributions are yours. Conversions, however, are different from contributions, and we'll talk about that in a minute. While you can withdraw your contributions, things get more nuanced with the earnings, the growth that's accumulated on top of your contributions. That's where the 5-year rules come in. There are actually 2 different 5-year clocks, and they apply to different parts of your Roth money. Clock number 1 applies to your Roth IRA as a whole. To withdraw earnings tax-free, your Roth IRA must be open for at least 5 tax years, and you must be over age 59 and a half, or meet another qualifying condition like disability or death. That 5-year clock starts ticking on January 1st of the year you first opened any Roth IRA. Once that window has passed, it applies to all your Roth IRAs going forward. You don't restart the clock with each new contribution. Clock number 2 applies to Roth conversions. Whenever you convert money from a traditional account into a Roth, that conversion amount has its own separate 5-year timer. This one doesn't affect whether the withdrawal is tax-free. You already paid tax when you did the conversion. But it does determine whether that converted amount could face a 10% early withdrawal penalty if you take it out before age 59 and a half and before its individual 5-year clock expires. So it helps to think of your Roth money in 2 buckets. 1, contribution dollars. They can always come out tax and penalty free. 2, converted dollars. They may have their own holding periods before they're penalty free. Both can grow together, but each has its own rules for when it can be accessed. This is why Roth strategies, especially Roth conversions, are most effective when planned early. Starting your Roth journey now gets the clocks ticking and sets you up for true tax-free flexibility later. Now that we've talked about timing, let's look at why now might be one of the best windows in history to take advantage of Roth conversions. We all know inflation changes what a dollar can buy, but what's less obvious is how our tax system has evolved. Let's step back in time and compare what a family earning $300,000 today faces versus a family with the same buying power back in 1970. Using inflation data, $300,000 in 2025 is roughly equivalent to $45,000 in 1970 dollars. So picture a married couple with 2 children making the equivalent of $45,000 in 1970. In 1970, the federal income tax brackets for married filing jointly started at 14% and quickly climbed through 16, 18, 22, 26%, topping out at 30% by the time you hit $10,000 of taxable income. The personal exemption was $600 per person, and the standard deduction was about $1,000. So that family had $2,400 in exemptions plus the deduction, leaving about $41,600 of taxable income. Applying the brackets of that era, their total federal income tax bill came to around $11,400. That's an effective tax rate of about 25%. 1 out of every $4 went straight to Washington. Now, fast forward to 2025. A family with the same standard of living earning $300,000 today will take the modern standard deduction of $31,500, leaving $268,500 of taxable income. Using the 2025 married filing jointly brackets, their total federal income tax bill is roughly $49,500. That's an effective tax rate of only about 16.5%. Compare that to the 25% effective tax rate in 1970. Think about that for a second. They earn 6 times more in real dollars, yet they keep more of each of those dollars than their 1970 counterparts. We're living in one of the lowest effective tax rate environments in 60 years. That's why Roth conversions today can be so powerful. You're choosing to pay taxes while rates are historically low. And in doing so, you're protecting future withdrawals from whatever rates might look like decades from now. And if you think rates might rise to deal with national debt or fiscal pressures, locking in a Roth conversion today can feel a lot like buying tax insurance for the rest of your life. So, how do you decide when to convert and how much? That's where strategy comes in. The beauty of a Roth conversion is that you decide when and how much to convert. Maybe it's a year when your income dips, between jobs, before retirement, or while you take a sabbatical. Or maybe it's a year when you make a large charitable gift and use that income deduction to offset the taxable income from the conversion. Each year offers a new opportunity to fill up your lower tax brackets intentionally. For example, some families convert just enough each year to reach the top of the 24% tax bracket, maximizing conversions without bumping into the next bracket. Other households prefer to spread conversions across several years to manage IRMA. That's the Medicare income-related adjustment that raises your premiums if your income crosses certain thresholds. The key takeaway is this: Roth conversions don't have to be all or nothing. They can be layered, timed, and customized to your situation, helping you smooth out your lifetime tax curve instead of letting the IRS dictate it later. And as your circumstances change, a promotion, retirement, selling a business, or even a move to a different state, your Roth strategy can evolve right alongside you. That's what true tax planning is. Not a one-time event, but an ongoing process of staying in control. Here's another thing to consider. If part of your financial purpose is to leave a legacy, Roth conversions can be one of the most thoughtful gifts you can pass on. Under today's tax code, most non-spouse heirs who inherit an IRA must empty it within 10 years. That rule replaced the old stretch IRA, which allowed lifetime distributions. Here's what that means. If your adult children or other heirs inherit a large traditional IRA, they'll have to withdraw the entire balance over 10 years. And those withdrawals are fully taxable to them as ordinary income. If your heirs are high earners themselves, those inherited distributions could stack right on top of their own income, pushing them into much higher brackets. In some cases, the tax burden on an inherited IRA can exceed 35 or 40%. By the time federal and state taxes are paid, the amount your heirs actually keep may be far less than you expected. A Roth IRA, however, changes that story. The 10-year rule still applies, but the withdrawals your heirs take from a Roth IRA are tax-free. They can withdraw the money on their own schedule, maybe all at once, maybe they do it gradually, without owing a dime in income tax. That makes a Roth a great way to pass wealth forward for families in this situation. It removes uncertainty, reduces complexity, and it allows your heirs to focus on their own goals, not their next tax bill. So if leaving a meaningful legacy is part of your plan, Roth conversions are one of the few tools that can help you create certainty in an uncertain tax future. Now, before you run out and convert everything, let's talk about the fine print. A Roth conversion is a taxable event. When you move money from a traditional account to a Roth, that converted amount is added to your taxable income for the year. That means two important things. One, you need a plan how you'll pay the tax. It's almost always better to pay the tax from outside funds, from cash or a brokerage account, so the full converted amount stays inside the Roth, growing tax-free for life. Two, you need to be mindful of what extra income might do to your other taxes. For instance, it could affect Medicare IRMA surcharges, which increase premiums if your income crosses certain thresholds. Capital gains stacking, where the added conversion income pushes other investment gains into higher brackets. Or even college financial aid formulas if you have children still in school. That's why coordinated planning with your advisor and your accountant is essential. A well-timed conversion can be brilliant. A poorly timed one can be expensive. Remember, tax laws change. The One Big Beautiful Bill Act of 2025 made many TCJA provisions permanent. But Congress can, and will, revisit the code again. Your Roth strategy should evolve right along with the rules. So treat conversions not as a single decision, but as part of a long-term plan you review each year. Wrapping up our conversation on Roth conversions, you've worked incredibly hard to build your success. And the more you've saved, the more exposed you are to tax risk. Roth conversions give you something rare in tax planning: control. They let you decide when you pay taxes and create flexibility for tax-free income later. Whether it's a backdoor, a mega backdoor, or a carefully staged series of conversions over several years, the goal is the same: to design a retirement income strategy that works on your terms, not the IRS's. We know the rules today. We don't know the rules tomorrow. And uncertainty, especially with taxes, is not a plan. If today's episode got you thinking about your own Roth opportunities, that's exactly what I help clients explore every day. Because Roth conversions aren't just about saving on taxes. They're about creating flexibility, freedom, and confidence in the future. You can build a future where you have more options, not more obligations. Where you can say yes to experiences, generosity, and time without worrying about the tax consequences. Thanks for joining me today on Living Your Wealth Today and Tomorrow. If you found this helpful, please share it with a friend or colleague who could benefit. And remember, live your wealth today and tomorrow. Thanks for listening to this episode of Living Your Wealth Today and Tomorrow. This podcast is for educational and informational purposes only. It is not tax, legal, or investment advice. Seek guidance from your legal and financial professionals before acting. For more insights on planning for your financial future, follow me on LinkedIn. And for more information on Infinity Financial Strategies, visit our website at infinityfinancialstrategies.net. If you enjoyed the show, please share it with a friend or family member who might benefit from listening, and please leave a review wherever you listen. Tune in next time for more tips and tricks on living your best life through financial planning.